Hey, it's Rav. Welcome to The Everyday Investor, the hottest real estate investment show in the world. That's right, I said it. I don't care who knows it. Today's topic, we're going to be talking about syndicated mortgages, group mortgages, how we can make money investing in group mortgages, syndicated mortgages, but specifically, not all syndicate mortgages are created equally. Of course, we have our mortgage expert guru extraordinaire, Carmen Campagnaro, is here with us today. Carmen,
hello.
Thank you so much for being here. It's always a treat when you come, and if I haven't said it 100 times, I say it again. Thanks for believing in the show so much and, you know, really kind of just sponsoring the show.
Yes.
And there's so much that you do. And what I love most about you is, you know, that we are akin to the holistic things, the spiritual things. We just talked about how you put an offer on a property just outside the GTA for 100 acres just so that you could, you know, declutter the soul,
Yep.
go for some walks, get rid of any kind of anxieties and, you know, kind of blah moments that we all kind of face. You know, it's so important. And whenever I talk about it, I mean, just last night I was doing a talk to 30, 40 people, teaching them real estate investing. And whenever I'm on TV, and I know you do the same thing, you know, we make money in real estate, but there's a why to it. And the why is to be able to give us some time. Real estate money can help to give us time to be able to really, truly enjoy nature, spirituality, family, friends, all that kind of good stuff.
That's the key.
Yeah, talk to me a little bit about how that's been your philosophy for many years now. I mean, I know your kids are, you know, one's in Bali in Australia, and other one's kind of working with you. You take a lot of trips to, you know, down south, but talk to us, nurture us a little bit, give us the maternal view on why it's important to really focus on the right things.
You know, for me, it's my passion are my children and my family and I think it's, if you have a good foundation and you're grounded personally, everything else kind of fits. And for me, the fast-paced life, like, we're very busy, you and I, right?
Yeah.
Our careers are very busy, so I need that time, that downtime, and I do take that time on evenings and weekends for myself, and I don't work on the weekends, and this, putting this offer, I hope I get it, I don't know if I will.
Yeah.
But it's a dream of mine to have, you know, land, North Burlington somewhere, where I can live off the earth, right?
Sure.
Grow my garden and
make some bonfires, grow your own fruits and vegetables.
I love it.
Have a big barn there for your pets.
For my pets.
You know, all that kind of stuff. But it is so important. And that's, you know, when you know, it's been 11 years since I've been doing a real estate show, and I just really want people to know that, for you to know that at home, that that's really what it's all about. And to be really honest with you, I know a lot of very, very happy people that have peace, that have serenity, that have joy in their heart, that really don't have a lot of money. And so it's not that, you know, money is even the answer to that.
No.
It can help.
Yes.
It can help, right?
Yes.
And you know, especially the products that you introduce, because it's very passive.
Yep.
You know, you kind of have two type of products, if you will. There's the private mortgages, and then there's the syndicate mortgages. And this is just passive income that just kind of comes out. There's some cash flow there, and that can help to be able to go to, you know, spend some time with friends, have people over, go down to, you know,
You'd
Disney.
be surprised how many of my clients actually invest, and they're traveling while they're investing. So you don't have to be here to manage anything.
Yeah.
You can be in Bali, or you could be in Europe, or you could be in Florida, and the funds still keep coming in.
Well,
so there isn't anything there to manage. Really.
Yeah, and I think a perfect example of that is you, right? You just got back from Florida.
Yeah.
Right?
Yeah, there you go.
And yet you're very, very busy, you know, still making money actively and passively. And so, you know, congratulations on that. And
Thank you.
So for people who don't really know who Carmen Campagnaro is, I mean, as young as you look, you've been in this business, the real estate business, and I don't want people to think that you're just mortgages. I mean, actually, that's just one of the things. You buy properties, you flip properties, you buy and hold, you refinance, you joint venture, you have partners, all that kind of good stuff. But I always want people to know and share with us really quickly, you know, when you're 18, 19 years old, you know, what you did with a property and how much money you made.
Oh, yeah, that was my first property I purchased was when I was 18.
Yeah.
And I'm not going to tell you what year that was, but basically we bought the house. I bought the house, and I went in with very little bit of money, and ended up selling it just before the crash happened. And I made about $100,000 on
$100,000 as a teenager.
House. Yeah, I was 18.
Wow.
Oh my gosh! So I ended up opening a business, and then people think, well, how did you do it? Well, I came into a little bit of money, not a lot of money, but I used that money as a down payment, and it was like an inheritance for me. So instead of going out and blowing it, I put it into real estate for some reason when I was 18, and I wasn't, very, direct person at that age. I was all over the place. I was experiencing life.
You weren't so focused.
I wasn't focused. That's the word I was looking for. And but I always enjoyed real estate. So even from then, and it just started from there. And I kept buying real estate and selling and buying and doing all kinds of things. And it's not all about just always making money. You go through the bumps, and I've experienced a lot of things since I was 18. So it's not all rosy. There's a lot to learn in real estate. You got to do it the right way, right? But it's great.
And it's not like you went to real estate education school and got your MBA in real estate for 5-10 years. So there is sometimes a cost. Sometimes there's a hiccup here or there, and we learn, and you count that as education. Right?
But even if you do have the MBA in real estate, now I know there are great programs like we know Keyspire. We're both. I think it's an awesome program, and they have something very good there, but you always have to experience things yourself to really learn it. And specifically me, because I'm the kind of person that if I don't experience it and someone tells me, Carmen, don't do that, I'm going to have to go do it anyway and figure it out on my own and get hurt. And then I'll say, oh, that really hurt. I should have listened. Right? But,
and you don't always do that, but sometimes I'm the same way.
Not always, but
the good book says, humble yourself or you'll be humbled.
Yes.
Unfortunately, it's mostly the latter of the two for me. And then you learn and you grow from it, and so on and so forth. So Jordan, your lovely daughter, she kind of runs Pro Funds. She's the president of Pro Funds there. And,
no, she's the VP.
VP.
Yes.
Sorry.
She's the VP.
Yes,
I'm the El Presidente.
Yes. You know when I say run it, I meant because you also, again, you're traveling, you're doing this and that. She's in there. I mean, very smart cookie she is.
She is. And, she's a hard-working girl.
She's VP of there, and that's fun. And your son says, Mom, not right now. I'm going to do some traveling and enjoy some life.
Yeah, she's a different. She was always a studious one. Went to school, went to university, really driven. My son, on the other hand, wasn't interested in university. Took his education money and invested in mortgages.
Oh, okay.
And now he's traveling and he is living off the interest there. So we put aside funds for him for university as well. And he said, no, I'm not going to do that.
So that's interesting. So you had like kind of a, the equivalent of an RESP, although you probably made more money. And he said, I'm going to take this money, Mom, and not spend it on university, but I'm going to be educate myself by being a world traveler. And
so that's what he's doing. He's out there exploring the earth right now. So he is a registered real estate agent. So when he comes back, he'll get into real estate as well, because they were born with that. Yeah. They enjoy born and raised in real estate. Well, I hope you get this property. So here we are in May, and I hope you get this 100 acres in Brooklyn. So you put the offer in. Yeah, that's there, and, being presented today. See what happens, and if you don't get it, then it's meant to be. I agree. Yeah. Yep. We'll go on from there. Exactly. So Pro Funds. How did we get to Pro Funds? Tell me about it. When did you launch it? Pro Fund Mortgages. It's not just a small little corner-side company here. So just a few minutes here before we go to break. Tell me a little bit about the birth of that. Well, basically started in my basement. My kids were very little. Had my washer and dryer beside me, my fold-out table, and my fax machine. And I would fax people. And I actually got a lead for a fellow that was looking for financing on a really crummy property in Hamilton. I got it done because I was like a dog with a bone. Determined. And you're a single mom at this time? At this moment? Yes, I am. And he happened to be a speaker at a real estate investment company. 150 people a month, put my name on the overhead projector. Wow. And I just went, boof, all these people. So it was really great. And that's how it kind of just started to grow. Real estate investments, we cater to investors for almost 2 decades now. Yeah, no. And I wanted to mention
the single mom thing, because I really applaud you. My mom as well, raised me and my sister, and sometimes you work hard, right? It's not like you had the luxury of not working with like a dog at times, because you've got two mouths to feed, and I think that's really, Carmen, a big reason why you're so successful. And so the rest is history. One of the biggest mortgage companies here, and you service people.
Things have really changed. It's grown exponentially. It's incredible. In the last 5 years specific, we've really put a lot of focus and energy into the company, and it's grown quite a bit. We've opened a sister company, which we'll talk about after.
Yes, Valour Capital.
Valour Capital, which
helps in developments.
And it complements the mortgage side so much, and it's a great thing that I want to talk about and let people know how the behind-the-scenes due diligence occurs.
Yeah, so we'll do that in a couple of segments. You brought somebody there that analyzes all our deals, that works with you at Valour. Lou is going to come on the show, so I look forward to that.
Yeah, it'll be great.
Listen, thank you so much for being here.
Thanks.
Can't wait to continue to talk to you about the world of syndicate mortgages. You're watching The Everyday Investor. Carmen Campagnaro is our guest on the show. Very excited to learn from her. You don't want to go anywhere. The Everyday Investor continues in a moment. Whenever you're considering to invest in real estate, always ask 4 questions to start. Number 1, what is the return on investment? Number 2, when do I get that return, along with the money that I put in? Number 3, what is the minimum cash amount needed? And number 4, what is the risk in the worst case scenario? Welcome back to The Everyday Investor. We're here with my good friend Carmen Campagnaro. We're talking about how to make money investing in mortgages. Carmen, it's great to have you on the show here. When we talked on the phone earlier, or we were talking earlier before the show, we wanted to talk about, there's different types of mortgages that we can invest in, and not all mortgages are created equally.
No.
Not all developments are created equally. But before we get to that, let's talk about just kind of the birth. We touched on it before the break, but just the evolution and where ProFunds has gone to from when you started it, however many years ago. How long was that when we started?
Oh my gosh, almost 20 years.
20 years, almost 2 decades. We started it. And,
time flies.
And here, but take me through, walk us through a little bit the evolution of and even just the mortgage world and how mortgages have changed.
Yeah, absolutely.
Yeah.
Well, I was telling you I was working there in my basement with my fold-out table, and the phone call came in from this real estate investment fellow. And then it just kind of it basically landed in my lap, led to financing investors, financing requirements for income properties and all this type of thing. So that's really how it all started. And back then, financing 95% loan to value on an income property up to 4, even 5 or 6 units at times was totally normal.
Okay, so explain that for a second. So what you're saying is, back then, if I wanted to go buy, a 5-plex or a 6-plex, and the property was, a few $100,000, I only needed back then 5% down.
5% plus. Back then, they would give you cash backs for your down payment. You could borrow your down payment. So
wow. So you're in for nothing.
It was so flexible. Yeah. It was so much easier to acquire a mortgage.
As opposed to now, you need
today.
Probably 35% down.
Well, as time went on, so we would finance these things, and yes, you're talking 25 or 20% down to buy in the residential side. So over time, we would be financing, and we became very busy with that whole thing. I would speak at events for 10 years for this specific company on teaching people how it works and how to get into an investing. And I as well, in the process, was buying property and selling and learning the way as well, right through it. So when we were working with investors, I came from both sides. I was in from both perspectives. It was institutionally, what are they looking for? And then from an investor standpoint, what do we need? And then we would evaluate the deals.
That's great.
And it really was an added value to all of our clients. So that's how the company really grew that way. And then in 2008, we had that really bad blip in the market, and the U.S. took a dump, and Canada had that 8-month or 1 year, whatever happened there. A lot of people lost a lot of money, and the banks tightened up incredibly. And private money was always in our realm. I always really liked working with private money because it was so simple. You could close quickly with the private money. So we were always...
So define that for a second. What's private money?
Well, it would be an individual like yourself.
Yeah.
And typically in the industry, private lending has been around for decades, forever, for a long time. Yeah. Only there was always a stigma behind private money. Private money was only the really wealthy guys that would do it, and or loan sharks. Okay, that was the image or the feel behind private money in the industry.
So
right?
Carmen wants to buy this investment property. The banks are tightening up. They're not giving her, helping her out with money. Along comes Rav, and I would lend you the money, and that's what we call private money. So as opposed to going to the banks.
Going to the bank, so you can lend. There isn't anything really there to regulate what you do and how you do and how you want to lend your money. You could, mind you, there is the cost of borrowing because mortgages are regulated by Financial Services Commission.
Yeah.
However, if you as a lender wanted to charge 25% interest, you can.
Okay.
Right? So I think that's where all that kind of
You
stigma.
can or you can't?
You can. You cannot exceed 60%.
60, oh yeah, well, I hope not.
The cost of funds cannot exceed 60%, including legal fees and broker fees and lender fees.
60% in a year. So
annual.
Yeah. So if I lend you $100,000, I can't ask for $60,000 back on top of my 100. But I could ask for 15%, 20%, 25%,
Yes.
up to 60%.
Up to 60, all inclusive, right?
Yeah.
So the returns are pretty good,
Yeah.
and back then it wasn't necessary really to borrow too much private money unless you were really in a distressed situation. So that's where all of that kind of came into play. But then when the market took a hit in 2008 and 9 and 10 and so on, the banks just totally screech, grind halt. You're no longer now allowed to qualify for a mortgage if you don't have your income verified. Okay, so meaning if you're self-employed and you earn $200,000 a year, but your tax return or your notice of assessment only reads maybe 35 or 40, where's the money? And you're not going to qualify, right? So they cut that out.
Which a lot of business owners, I mean, myself included, right? I have an incorporation. My money goes through my incorporation. I don't show much. Everything's above reproach. Everything's legal,
of course.
but I just don't show much with personal income.
Right.
So if I want to buy a property that's not in my Inc. and I want to do it personally, it's almost impossible.
And prior to, you could just write a self-declared letter, and the bank would accept that. Today, forget about it. Like they'll scrutinize every single thing, and if you aren't, and it's all about your total debt service ratio, which means all your costs, taxes, insurance, credit cards,
car
loans,
payments, everything
has to not exceed 43%.
Okay,
of your income.
So if somebody makes $100,000 a year, they cannot exceed $43,000 a year
in debt payments
on everything: mortgage, car, hydro, gas, everything.
Yes.
Wow.
So that's the general rule of thumb right now.
Okay.
Some of them go up to 50. There's B lenders in our industry that kind of do something different, but generally speaking, buying multiple properties, buying income properties, buying a property if you're self-employed, there's so many things that have changed that restrict people from qualifying for a mortgage. So now we don't have any choice, but we have to go to private money. So it's, and this has been like this for a few good years now. Now, mind you, the rates are really low, so there's a lot of incentive to get bank financing. But if you've got a vacant building, for example, and you want to buy it as an investor and it's vacant, the bank won't touch it. Right? And
the reason why the bank won't touch it is because they want to see some sort of income.
Right, so that's on the commercial side.
So if it's vacant, they
yeah,
won't
5, 6, and your income would have to qualify on the residential side. So then if you venture into commercial's mostly based on the building's ability to service the debt.
Yeah, but if it's vacant.
If it's vacant, you're not going to get a mortgage there from a bank. If it's 50% vacant, you're not going to get a mortgage from a bank. So you're going to go to private money. So private money has become such a calling in our industry, specifically to our company because we deal with majority investors. And that's when this all started happening. And we started actually taking our investors say, hey, Rav, you're buying real estate, but do you want to put money out too? Do you have RSPs or stuff like that you want to invest into a mortgage?
That's a great point. So I want the people at home to understand that we can lend our money out, and it's not just cash money. It can also be registered money, RSPs, RESPs, TFSA, all that kind of stuff.
It's eligible.
Okay.
And just for clarity for people, mortgages are actually registered on title on the real estate through a law firm. Okay, so it's not just
like the bank would.
Just like the bank. That's why the bank is so happy to do it, and they're making a killing. The default ratios are low. As long as you have your security on the real estate, a loss is very few and far between.
So if I lend Carmen money, it's just like one of the big banks lending Carmen money, and so I have a place on title. of your asset, which is your property.
Yep.
So if anything were to happen, then I can,
Power of sale, sell the property, and realize on your money.
Okay.
So there's a way to recoup your funds. Like you have security on something. You're not just getting a piece of paper and saying, here you go, a stock or something like that. It takes a hit in the market. In your history, you got to wait maybe for it to come up in 10 years or something like that. You actually have security on real estate. So with our company, what we do is we get a lot of private deals that come in. We have something called an individual mortgage, which is, let's say, myself, I'm looking to get a mortgage on a property. I need to close really quick.
Yeah.
And I use private money a ton. Why?
Yeah.
Because I don't care if I have to pay 10 or 12. I'll pay fair market on the rates and everything else. But if I can close in a week and get 200 grand off my purchase price because I'm closing really quick, or I win the deal because there's multiple offers, it's worth it. So I use it. So what happens is...
Of course it is. I mean, there's many people that have watched this show, and like just last week, we showed numbers where people are making 500% on their money, 800% because they're doing it, they're pulling money out, so on and so forth. For them to borrow $100,000 and pay 10 grand on that 100,000 is nothing to them because they're making a lot of money. And to your point, they don't have to go through the headaches of perhaps through the bank. They can close quicker. And then for me, if I'm lending to Carmen in this individual mortgage or private mortgage, right? Synonymous, same thing. Private mortgage, individual mortgage. If I'm lending to Carmen, I can look at her. I can ask all the questions I want. What's her net worth? What does she owe? Does she have this this beautiful 100 acres in Burlington? We'll find out. All this kind of stuff. So that's why
maybe you'll lend on that 100 acres in Burlington.
Yeah, exactly. And so that's where I get to look at just the individual. We'll talk about the group mortgages, the syndicate, where it's a development. But on this, we'll talk about
exactly. So that's how it started, Rav. And so many people were looking for private money, and we had so many investors we were working with. We had like 10,000 people that we had on our database from all these events and talking to people and investors working with our company. So we were the middle people actually coordinating the whole thing. This guy needed $200,000. This guy had $200,000. So what we do, and what we did and we still do, is we do the assessment or the analyzing of the deal to see if it's a viable investment, right? So where's the security? Where's the real estate located? What kind of a mortgage is on the property? What does the person look like? We pull their credit bureau. We'll pull company information if they have a company. We'll get as much.
You'll do that on Rav's behalf before I invest with Susie.
And we will send it to you. And then if you say, we'll get appraisals. And not just a letter of opinion, just so you know, it has to be a real legitimate appraisal.
What the property's worth.
That's so important because that's your value, that's your security, and that's a really key comment there because it's all about the value, the loan to the value of the property that you have as security. So this is very important for us to know. And that's why I'm mentioning that because later when we bring Lou on, he's going to talk about that type of stuff.
And Lou, he analyzes the syndicate mortgage developments that we do to be able to see, is this a great deal to go into? Is there a lot of equity there? So on and so forth.
Security, feasibility of a project. But this is individual mortgages, so we're as diligent there as we are on the other side.
Perfect.
So,
always wonderful to talk to Carmen Campagnaro. Don't go anywhere. When we come back from the break, we'll learn more how we can make money investing in mortgages. Thanks for watching, everyone. Did you know that when investing in mortgages, you can expect fixed returns on average from 8% to 16% a year? Hey, it's Rav. Welcome back to The Everyday Investor. We're talking about how we can make money investing in mortgages, both private mortgages, group mortgages, synonymous with syndicated mortgages, and specifically, not all mortgage opportunities are created equally. Carmen, it's great having you here.
Thank you.
Who's this young, handsome man beside us? Lou
Falco. This is Lou Falco from Valour Capital.
Valour Capital. And there's a marriage between ProFunds and Valour Capital.
Yes, it's a sister company to ProFunds. And it's the actual due diligence arm to the company for the construction and development projects, as well as it handles the construction management after the fact as well. So there's a lot more to do with Valour than just preparing a package to sell mortgage investments.
And that's more on when we're getting into the syndicated, the group mortgages, because that's now we're getting into development, right? And so Lou is brought in as a VP and senior analyst for Valour Capital, and it's great to have you on the show.
Pleasure meeting
Lou.
you as well.
Yeah. Before we talk about syndicated group mortgages, Carmen, let's continue with our conversation there on private lending. Before the break, we were talking about, so there's kind of two categories. There's people that have money, and even registered monies, that want to lend out their money because they really enjoy the cash flow. And they can lend out on a private mortgage. You can kind of hook me up with, Susie or Jeff or whoever it is. I get to look at their whole portfolio and then make a decision. Do I want to lend them 100,000, 200, so on and so forth. But on the other side is Rav can make a lot of money in real estate. I want to be shrewd, smart. I want to be able to close quickly. I know that I can make a lot of money, so I don't mind paying 10, 11, 12% on my money that I'm borrowing, if all the numbers kind of work. So you kind of have both, and this is happening a lot. Now, of course, with interest rates being so low today, a lot of people obviously try to get cheap money first.
Yes.
But again, you always borrow. I mean, you're the queen of mortgages, and you always borrow private money.
I do.
Because you get great deals.
I do. You know what? I use it as my negotiation tool. And I can qualify for a residential mortgage. I can get a bank mortgage, but that's actually the private money is, bridge. It's your short-term solution to something when you're borrowing the way I do. I'm not borrowing because I need to consolidate my debts and things like this, and 90% of our deals are like that because they're investor related.
Yeah.
There are some people that need to do debt consolidation, and they'll pay off all their credit cards, and we'll do a second mortgage on a property. But you know what, there's also investors that like to borrow because they can negotiate a really great deal, and that's why they borrow, and their credit is good and
so
things
give
like
me an
that.
example for the viewers at home. What do you mean by they can negotiate a really good deal, and what does that have to do with borrowing private money?
Okay, so
Carmen wants to borrow from Rav.
Yeah.
Tell me about a deal where that comes in, how it gets you a great deal.
Okay, so if the beauty of private money is there's less red tape. Okay, so we will do pro funds, and the team, the people that do the underwriting at the company, will go through a deal and see if it's a fit for our company and our investors, because our first priority is our investor security. We don't want a bad deal. We don't want to have to deal with that kind of stuff. So what we do is we go through everything with a fine-tooth comb. So a person will come to us and say, you know what, I have an opportunity to buy, let's say, a 6-unit, and the people that are selling really need to close quickly. They're going to lose the property or something. Can you get me financing on this property and close within 2 weeks? Yes, I can. Because with private money, we can get an appraisal done in a couple of days. We can, depending if it's a commercial or residential, typically residential, yes. A couple days. If it's commercial, a week, we could probably pull it off. And then closing, you need at least 4 days to get that done. So it's your buying power. So if you have a relationship with your broker or a company like us, and we know who you are and we're dealing with you, or even not, and you come to us and say, hey, I've got this deal, I've got to close quickly, can you help me? Yes, I can. Now, this guy might save himself 150 to 200,000, 50,000, even 30,000.
Yeah.
But to close on it really quickly, he'll get the deal.
And he might only pay on 100 grand. He may only pay 10, 12 grand.
Yes.
So I save 30 or 40,000 on the purchase, and I pay out 10, 12,000.
And then you can go back and get the bank rate once you've closed the deal. Or let's say that it's a creative deal, and creative meaning we don't want to do anything unethical. So let's say the seller has agreed to give you $25,000 towards renovations of your home.
Yeah.
Well, the bank won't agree with stuff like that. The vendor will let you do a VTB, and you're getting it under what it's really worth. So what you can do is you can close with all these extraordinary situations.
You said VTB,
the vendor take back
the seller, the owner of the property. He will give me a mortgage. He'll lend me some, so I don't have to give him. Let's say it's $500,000. I can maybe give him $200,000, and he'll lend me the rest.
Yes,
okay.
And the property is worth a little bit more. So maybe you arrange to get private money to close on that. The private lender doesn't mind. He's in first position.
Yeah.
His security is there. And what happens is then maybe in a year or 6 months or 8 months or 2 years, whatever the term is, what we think is going to work, because we'll help assess all of that, we'll go to the bank and refinance everything and take out the private. So now you've acquired this property with very little down.
Yeah.
You've used private money, but yeah, it cost you a little more, but so what? Look what you acquired now.
Yeah.
So it works out really well, and I've done that numerous times. So personally, I love borrowing private money, and I don't care if I have to pay the extra money for that. It's so worth it because you got to look at the big picture. So that's private individual lending.
Yeah.
And then there's deals that we get in at the office again with individual people that are looking. For example, we just had a deal. The fellow needed a $2.5 million first mortgage. He had horrible credit, but the loan that we were lending to the value of the real estate, and it was very viable real estate, and great acreage, 40 acres, nice home. It was only 63% loan to value, and the return for our investors was 12% a year on their money. So
when you say that 63%, so what that means is there was 37% of equity
value
in that property.
That's right.
And so then therefore somebody absolutely would lend them 63%, because if anything would happen, they'd gladly take the whole property.
You can certainly sell it for, 63 cents on the dollar, okay? In this market and that type of real estate.
Got it.
And our investors made 12% on that. So now, because it was $2.5 million,
Everybody wins.
It was a larger mortgage, and we also, we do have some investors that would come in with the 2.5, but we have so many investors, we want to make sure their money is working for them.
Yeah.
So we give them the opportunity to all participate. So the minimum investment on that was $50,000.
Yeah.
That's considered a syndicated mortgage.
That's considered. So okay. So I was incorrect when I said, and Lou, you can help us out here, when I said that syndicate mortgages are in real estate development. Not necessarily.
No.
Syndicated mortgages, Lou, just simply mean a group of people putting their money together, maybe just to lend to Rav.
Could be just two people coming together.
And then we call that a
that's a
syndicate
syndicate
mortgage.
Exactly.
Okay, great. So you, Lou, you are first an investor, right? You are a
developer.
I developed. I was involved in the development project.
Yeah.
So I got to know Carmen and the group at Valour and ProFunds, and was really interested in what they were doing and what the opportunity that was being created in this marketplace. It's a phenomenal opportunity to bridge the needs of developers and people that have solid investment opportunities. And so part of our job is to certainly vet out and do the due diligence that's needed. We might see 5 to 10 deals in a week and maybe pass on all of them. We look for opportunities that are we're kind of in the risk management and assessment, meet the needs of our investor group. And once we find something, it's really kind of then coming together for the bridging the capital and structuring something that's going to be kind of a win-win-win for everybody. So the developer that has a chance to get this project underway and completed. Yeah. And then we're the vision of Carmen and the group at Valour has been terrific in the sense that they've taken this thing from helping raising traditional mortgage lending and syndicated lending, but then taking that to the next step, which is really the Valour model. We've got a team of people, project accountants, project coordinators, project managers. We just brought on an expert, actually a real estate person that helps us on our portfolio of properties that we have. We work on exit strategies because a lot of people. You got to be thinking the long-term game.
Yeah, how am I going to get out?
How are you getting out? Are we going to roll this thing into a REIT? We're actually in the middle of
establishing
a REIT.
Lots happening.
Real estate investment
trust. Yeah, so we've got an exit plan. You come to us as a developer. Yeah. We assess what you're doing, and we're going to not just help structure that financing for you, but we're going to take you through, and we do. We've just invested. In resources in terms of technology, our infrastructure at the office, for internet, for software, we just brought on
construction management software.
New construction management software. We're using top of the line, top in the industry, both property management and construction software. So bring in the tools so we can help the developer kind of work through the accounting and management. That's part of our investor security blanket as well, because not only are we're helping the developer, but it's also part of our role to ensure that the project is being managed and seeing to an end as budgeted and planned.
So we're going to cut to a break here for a second, and then we'll come back and we'll talk in depth of this. But we talked at length, Carmen, about the private mortgages. This, in a sense, one category of the syndicated is still kind of private in a sense, because what I'm learning is Rav and his sister Rita could put our monies together, lend it to an individual, and now this classifies as a syndicate mortgage.
Absolutely.
Yeah, so there are two. So there's the
A and B.
And I wanted to mention this because there's some, again, buzz in the market about syndicated mortgages. There's
an article that came out.
Yeah,
a
and
few
you know
articles.
what? It's not. That is just so it's like looking in a little pee hole there. Like you can't see the big picture here. Syndicated mortgages are what we did, the 63% loan to value deal. That's not bad. It's great. But people need to understand what it's all about. It is fantastic.
If it's 63% today's value, loan to value, I mean, that's fantastic.
So that's a syndicated mortgage, and then we have syndicated mortgages that go with development. And it's not all the same. All syndicated mortgages are not the same. And that's why we really wanted to talk about this and let people know that if you have a great team and due diligence is done, you have execution happening, you have securities put in place, you know that you've got a loan to value, you're doing appraisals on these development projects, not just the values of opinion. You're getting a legitimate AACI report. You're good to go.
Well, listen, I look forward to learning when we come back from the break. I want to learn how the development works with syndicated mortgages. You don't want to go anywhere. The Everyday Investor continues in a moment. Thanks for watching, everyone. Did you know that when it comes to investing in mortgages, registered funds are eligible, meaning RRSPs, RESPs, TFSAs, LIRAs, etc.? Hey, it's Rav. Welcome back to the Everyday Investor. We're talking about how to make money investing in mortgages. We've covered how to make money in private mortgages. We've talked about how to make money if 2 or 3 people are putting their money together and lending it to an individual person. That's called syndicate mortgages. And now we're going to talk about how we can make money with a group of people putting their money together, lending it to a developer, and making a return on their investment. I have Lou Falco with me, as well as Carmen Campagnaro. Guys, it's great to have you guys on the show.
Thank you.
We've talked a lot here, and now kind of, Carmen, we touched on the fact that, you know, this, and correct me if I'm wrong, when a group of people lend their money to a developer, we've kind of termed it, the industry's termed it syndicate mortgages.
Yes.
But there's always been a group of people lending to a developer. There's always different partners involved, but this terminology of syndicate mortgages is of recent. Is that correct?
It is. It's just so many more people are gaining knowledge of the industry because there's some companies out there, you know, taking it by storm. And, you know, we've always been doing it. It's been around forever. It's been around for a long, long time. It's a matter of how things are done to protect the investors' interests. And that's exactly why we launched Valour, because I saw it. When ProFunds was growing, I said, whoa, you know, and people were coming to us for construction and development financing. I'm not going to claim any fame to being a big developer, because I'm not. I know about it, but I'm not by any shape or form an analyst that's going to go in and challenge every nook and cranny.
And that's where Lou came in.
So Lou, we have a whole team. So Valour is comprised of quite a few people. And Valour was established to actually assess a deal, feasibility. Can you actually sell these units at the end of the day for this amount of money? Is it worth this much money? Do we do appraisals and everything? We put together a special program for these investors and developers. And Lou is a CA, was a CA. He's now he is our senior analyst. He's amazing. And he'll go through, and he's so detail oriented. I commend you on that, because I can't sit there and do that. But, you know, and that's part of the whole team. We have construction managers, we have the analysts, we have accountants, we have, you know, everything's in play to make sure that we've got a nice package ready for our investors and that it is a safe investment vehicle. And the difference between our company, and I'm going to just say it really quickly and then I'm going to let you speak about what we do, but is that we actually have an interest in the project as well.
So you invest in these projects as well?
Well, this is how it works. We get a project, we do our due diligence. If we think it's a good deal that we could put our investors in, we're behind the project because we have an interest in the project. We own maybe 20%, 50%, 30% of the project. That's part of the criteria. And we manage the money, we control the money. We know what's happening with the project on a daily basis. So as the developer
needs money, you give out incrementally. It's not like you just hand it there
exactly.
and hope for the best.
And we're on a daily basis, we're involved. We're not just a lender to say, here's your money. Oh my gosh, I pray for the best. Hope it works out, right? And you know, and if it doesn't, oh my gosh, right? So we're involved daily, and Lou, he's from the very beginning. When the deal walks in the door, I'll take a look and I'll go, okay, Lou, or Darren, or part of Richard, any part of the team. Here's a new project. Go nuts, and then you can talk about what you do there.
So explain to me how it kind of works. So let's say there's ABC developer. and he's got a property in Burlington, and this development, the entire cost of the development is going to be what? I mean, just from one of our past deals.
Do one example.
Give me a live example.
Well, I have an example. We're doing a project in Ayr right now, for example.
Where?
Ayr, Ontario.
Yeah.
Ayr, Ontario.
AYR.
AYR, yeah.
Okay,
Just
yeah.
outside of Kitchener-Waterloo area, a growing bedroom community for that fast-growing area of Kitchener-Waterloo.
Okay.
But let's say a project like that might need about $9 million to kind of get off the ground in terms of the development costs. And that project would come to the table. We, like I mentioned before the break, we get about maybe anywhere from 10 to 12 deals come in per week that we're vetting and looking at.
So with this particular project, what are we building?
We're building actually a mix. There's 82 townhomes. There's
82 townhomes, okay.
2 apartment units with 24 per unit, so there's 48 apartment units.
Yeah.
And there's a commercial building. So there's three.
So we're going to build all this?
All this.
Wow.
Over a four-year projected period.
And so the total cost of this, a couple $100 million to be able to build the whole thing?
No.
No? Okay.
We're talking the total cost of build. It's about a $35 million project.
$35 million, okay, great.
$35 million
And the developer now is saying, we're going to raise funds. I want to borrow about $7-8 million.
Exactly.
And that $7-8 million is going towards
land. Well, there's a land purchase that part of the equation, and putting in the initial development costs, all the soft costs that go into
getting it ready.
There's a road. Fortunately, there's services already to the property.
Yeah.
And this particular person has spent the last couple of years actually with official plan amendments, and one of the things with Valour,
it's approved, right?
It's approved. So we'd like to take on projects that are ready to go.
Yeah.
So basically,
we're not taking grandma's,
cornfield.
We're not taking Carmen's 100-acre property that she got. Congratulations. And it's not serviceable to build these commercial properties per se.
Yes.
We're not doing that and hoping for the best.
No.
This is almost ready to go.
Yeah, it's ready to go.
Okay.
There may be some conditions in the site plan approval that look like when we vet it that's going to be complied with.
Okay.
And so we will. And again, I think we talked about banks and traditional financing earlier. They like things to be, pre-sold. They want you at the next step. So the whole idea here,
that's normal in Ontario, right?
Yeah, that's normal. And we look at like a pyramid in the sense that we have traditional financing. We have a mezzanine level of financing that gets into some of the soft costs and other costs that aren't picked up by the bank.
Yeah.
And then you have the equity layer. So it's a kind of a pyramid of sorts. But
So Rav and his friends are going to lend $8 million
yes.
to this particular developer.
Yes.
You said a portion maybe for land?
Yes, unfortunately.
And then we have what soft costs. I mean, that's marketing. We've got to sell all this.
And some development costs. We're putting in some roads and services into the property.
And that's also creating value, though, as we're lending that money and it's being released.
Yeah.
We're actually creating value, and the value of the property goes up. So it reduces the loan to the value for the investor. So it's additional security as this work is getting done.
And one of the roles of Valour is not only to do the assessment, the risk, really in the risk management business and making sure everything is protected. So we're not just, when we assess the whole project, we're also managing loan to value ratios. Carmen's, we want to make sure the project stays within a targeted loan to value ratio at all times.
And that just simply means that there's always equity there.
There's always equity there. So
we're not going to the edge where if something happens,
Right, and these investors are actually registered on title on this property, okay? On the whole project.
Yeah.
So that's their security. They have a tangible asset there.
Yeah.
And that's what the key is.
But I think, and again, because I don't know anything about this, if we go too close to the edge, though, and something were to happen, I'm in second position, right, after the bank. And so therefore, that's why it's important to make sure that there's enough equity there.
Yeah.
Is that correct?
We're not always a second position.
Oh, sometimes
we may be a first position
We're
mortgage.
starting in first, as in this case of Ayr. We're actually
It's a first
starting
mortgage.
in first.
Oh, okay.
And then once we get to the construction part, we'll bring in a construction. We'll bring in
Bank.
a
The bank gives the money for the construction.
and we'll postpone to the bank. So,
Okay.
so we'll
I just want to quickly say that when the banks lend the money, you know how difficult it is to get funding.
Yeah.
So when they release money, they investigate every little penny that's gone out. So they won't release money unless the work is complete.
Yeah.
So it's not increasing anyone's risk. It's
Yeah.
actually a good thing because we know now that the bank's in there and they're lending money because we're building.
Got it.
Right?
Got it. Okay, so this whole project costs, let's say, $30 million.
Yep.
To get it going, we need to borrow $8 million. So it's the whole project's $30 million. To get it going, let's say it's $8 million. I'm in first position. If anything were to happen, then I'm entitled to that land, Carmen.
Yes.
Me and my buddies. And then we, kind of sell out whatever we're building. Then the bank now comes and they will lend the other $22 million. And now they'll come into first position, we'll fall in behind, but the bank wouldn't have done that unless there was enough equity in there.
Correct.
For there to be enough room for everybody.
Correct.
That's
Is that what we're saying?
Yes.
Or we may even coexist. So in other words, investors may stay on.
Yeah.
And the construction financing, fortunately, some of the projects we like to get involved in are smaller or phasable, not necessarily smaller, but phasable projects. Because when you build, let's say, a high rise,
Yeah.
it is you got to build the whole thing before you start selling
Yeah.
units. You can't.
But
have
with
people-
this, if we do the townhomes first, which take a couple years maybe,
Yeah,
I
or-
actualize returns, then we're going to do the commercial, and then we're going to.
Yeah, or even blocks of certain. You start off the towns in blocks, so there's money flowing. So at a $35 million project, you might only need 10 to 15 million.
Yeah.
To,
Yeah, again, we don't give the whole 30 million to the
exactly.
developer and say good luck.
Yeah.
Right? It's incrementally. And so on this particular project, Carmen, what are the returns now that we're looking at?
You're reading my mind. I was just going to blurt that out. Yeah. 14% is what we offer on our project. So it's an annual return of 14%.
14%.
Yes,
So
and
if I
that's
invest
fixed.
If I invest $100,000,
You get
I
14% on your money.
$14,000.
Yes.
You said it's a 4-year project.
Annual.
Yeah.
Yeah.
So I get $14,000 a year.
Yes.
And then when it's all done, I get my 100 back.
That's right.
It's not quite that actually. It is 14,000 overall. But one of the things that's really attractive about the Valour model and why it's attractive to both the developers is we have something called the Deferred Lender Fee. So the actual coupon that's being paid throughout the project is 7%
A year.
a year, and typically, we might tee this up as in the project itself is going to take 4 years. This might be a 2-year program because there is sales going on throughout. But this
Most of ours are 2 to 3 years.
2 years.
We don't really do much beyond that.
So if
And-
this particular project was 2 years,
Yeah.
I put out $100,000 with a whole bunch of other people. They do the same thing, or more or less. Minimum's $50,000. You said on this particular
Yes.
project.
Yeah.
So I put out $100,000. Each year I'm getting back $7,000 for 2 years. So $70,000 year one, $7,000 year two, and then when we're done, I get another $14,000
Exactly, yes.
plus my 100 back, obviously.
Yes, and I also want to really be clear that 14,000 is not a variable. It's not contingent on the project making X amount of dollars. Our returns are fixed, which means it's contractual, it's in the agreement, it's registered on title, so the return of 14% is fixed. It's not like you're getting 7 and if the project makes this much money, you're going to get another 7.
Okay.
It's straight up 14%. There's no wishy-washy on
It's
that.
actually
end of it.
secured as part of the overall debenture. So,
Yes.
So like your deferred lender fee is part of the claim of the first mortgage.
The registered
debenture.
charge.
So
Yeah.
Carmen, we've been on the show with me many times. We ask, what's the return on investment? We're talking about 14% divvied up in different structures, different ways. The second question is, when do we get it? Well, you get 50% of it yearly, and then the other 50% on the back end. What's the minimum investment amount? We always ask, and in this case, it's $50,000. And then the fourth question that we ask is, what's the downside? What's the risk? What could happen? And what I appreciate about you, Carmen, is that you always tell people, hey, there's risk in everything in life, and we've got to make sure that. But as long as there's knowledge and we can mitigate that risk, then we're good in anything. So what would be the risk? And sorry, we only have about a minute before we go to a break here, but what would you say in something like this?
The market, I think, is the worst thing that could happen, right? It's
Yeah.
the market. If the market takes a hit and then values are affected.
But it would have to take a hit within the 2 years.
Oh,
Yes,
it would,
within
yeah,
2
it would
years.
have to be really
Yeah.
serious
And more
as
than
well.
and more than 10 to 20%, which is a typical equity in the project. So if we have an 80% loan to value, let's say
90 even.
90 even, like there's 10% or 20% loan to value. So in this particular project, we're managing between a 75 to a 90, depending on where we are in the cycle.
Yeah.
So that loan to value, we manage that and make
Yeah.
sure that equity is
There's
there.
always enough
And it's
equity.
validated through an appraisal.
Yeah.
If there is an issue with the builder for whatever reason, we have construction team.
Yeah.
We can go in, parachute in, and finish the project.
One key thing, I don't know whether you have time here, but one key thing I want to clarify too, on the loan to value ratio, we only calculate loan to value based on dollars we're spending on the project that's improving value. So if certain monies are going out for marketing or consulting, it's shovels in the ground costs that are going, that we consider that
whatever's improving the property,
yes,
right? The best for the best use.
Yes.
And yeah, for the
So no funny
value.
stuff.
Yeah.
Yeah, it's important, right? People need to be, and you know, we also have exits determined for our projects, and we're launching a REIT. It's a ProFunds REIT. It's in process right now.
So is that going to be private or public?
It'll be private. It's a private REIT.
Okay.
So most of our projects that we're involved in are being built as rental.
Yeah.
We have 5 projects in Milton. They're all mixed use or residential being built for rental, and they're all going to be sold off to the REIT. So investors have the opportunity to know that, first of all, when they invest in this, there is an exit, and secondly, they can get involved in brand new income property REIT.
So it's to be an apartment, kind of, not an apartment building,
Mixed
but
use, commercial.
mixed use, commercial kind of REIT.
Yeah.
And the yield on that, we're kind of looking anywhere between what, 7 and 9%, maybe?
Exactly. Yeah.
Yeah, you got it. And then if you calculate all the other things, that the person we're working with, the consultant there, you know, it's about 12% a year.
It's equivalent to, it's a tax preferred return with the shielding that goes on with the REIT and the way it's distributed. So that, as you know, there's been a lot of press about REITs, and it still continues to be a tax preferred treatment. So that an 8% REIT income may be equivalent to like 12%.
It'll be a diversification for people.
Interesting stuff, guys. I'm so glad that you're on the show here. We're talking to Carmen Campagnaro, Lou Falco. When we come back, we're going to have Carmen's closing thoughts. Thanks for watching, everyone. If you have any questions pertaining to this show, or there's a topic that you would like covered, please visit www.rogerstv.com. Hey, it's Rav. Welcome back to The Everyday Investor. We've had a phenomenal show talking to Carmen and Lou about group mortgages, private mortgages, not all mortgages being created equally. Carmen, thank you so much for being on the show. We have like 30 seconds for your kind of maternal thoughts, you know, to the investors at home. What would you say about, you know, investing in mortgages? I
would say that what you hear out there every day is not exactly what it is, and what the media puts out there is one thing. They're just digging for stuff to find something juicy to write about. But the fact of the matter is, this product and this investment vehicle has been around for a long time, decades, and it's made people a lot of money. So don't be fearful for what you hear out there. Really dig and look for yourself, and it's all about the company. It's not the vehicle. It's who's behind the scenes. You know, what is that company all about? How long have they been in business?
Fantastic, right? And you're absolutely right. We've got to do our own due diligence. You know? Carmen, thank you so much for being on the show. I can't wait till you're on again. On behalf of myself, Rav Toor, and Rogers TV, we'll see you next week, same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.